Hello, and welcome to the Motor Trade Radio podcast, powered by Cazoo, with Philip Nothard and Curtis Hutchinson, bringing you all the chatter that matters across the car retailing sector, from factory to forecourt.
For joining us for this special weekday episode of the Motor Trade Radio podcast. Today, we're delighted to welcome Ash Passant, Managing Director of Greenhous Group, and National Retail Director Danny Minshall. The Shropshire-based Greenhous Group is a family-owned multi-franchise business representing Ford, Nissan, Stellantis and MG, as well as new entrant brands including Chery, BYD, Jaecoo, Omoda, Geely and Leapmotor. Founded in 1912 by Vincent Greenhous as a motor repair and sales business in Shropshire, it is still family owned and operates multiple retail dealerships and fleet centres across the UK. It represents 12 OEM partners and is ranked at number 9 in the AM 100. Ash and Danny are joining us today to talk about the group's performance, current and future plans, and in the first half, share some of their views of their recent fact-finding visit to China. So welcome to the podcast, Ash.
Morning, guys.
Good to have you on, and welcome to you, Danny.
Morning, chaps. Finally got us on them foot
Yes, we did.
after promising for 2 years.
I've been trying for a while, Danny.
This has been a work in progress, hasn't it? So we finally got you on, and we're delighted to have you on today.
No,
Thanks for having us.
it's great, and I mean we will get onto it, but hopefully you've managed to catch up on your jet lag and get some rest.
Yeah, just about. I think we've had 2 trips, haven't we, Ash, in the last 40 days? So it's took a bit of recovery.
Stop going to China. That's the answer.
I don't think it is right now.
Yeah, I don't think we can stop going to China. It seems to be the epicenter of the automotive world at the moment. So if you can get yourself over there, get yourself over there.
Yeah, definitely. I know you've been over there. So I mean, great to have you both on, and I think it's very timely, as we know. So I mean, let's start off with that trip to China. I mean, as a group, that you've really embraced the new entrants, and obviously predominantly by Chinese brands. And I mean, starting with yourself, Ash, on this one. I mean, can you give us some of your impressions of what you've been seeing in your visits to China recently?
Yeah, so I guess we've been twice, as Danny said, we've been twice in the last 40 days or so. And first trip out there was with our hosts, Geely, our probably most recent Chinese partner. And that was really to see the motor show, to see Geely's product that's coming down the track, including a couple of their subsidiary brands such as Jaecoo. I think, as anybody who will say who's been over to China and who's seen the motor show, I think it was Danny and I's third motor show. What you can never take for granted is just the sheer scale, whether that be the amount of products on show, the amount of brands on show, the ever cycling change of product. You never see the same product twice. It doesn't feel like, and the speed of innovation. They are working 5 years ahead of what we're seeing at the moment, probably 10 years ahead. We only see what they want us to see. But yeah, that scale, until you've seen it with your own eyes, you just cannot fathom it.
So you managed to get the steps in, presumably.
We definitely managed to get the steps in. I think that somebody told us that the show, from the first show that we've been to, it's tripled in size in 3 years. I think me and Danny walked about 40,000 steps on the press day. And I still think we probably missed a couple of the halls. So yeah, there's plenty to see. You could easily do 3 or 4 days at the show alone.
And Danny, I mean, what were your impressions of it? I mean, obviously, you and Ash have been, going over there and looking at what's coming in the UK, what's already here in the UK. I mean, you must be amazed in terms of that size, that scale, and as Ash has pointed out, 5 years, and everybody talks about China being 5 years ahead in terms of advanced technology, innovation. What was your impression of that?
Yeah, I mean, my thoughts are similar to Ash's. The scale is phenomenal. The products that they're bringing to market are incredible. I mean, just last week we were being driven around Shanghai in an autonomous car, um, which you just didn't believe would be the case just a short few years ago. Um, the other thing is there's brands even that we haven't heard of, and we've been to China sort of 4 times in the last couple of years, and every time you go back, you find another brand that you go, well, who are they? Who's the parent company? When are they coming? Are they coming? Would it work if they did come? So it's surprising us every time we go, and we feel like that, we've been and lived it and seen it. But I think we've just seen a thimble full of what they've got to offer. I really do.
And following on from that, as mentioned, you currently represent a wide range of new Chinese brands. There's Chery, BYD, Jaecoo, Omoda, Geely, and Leapmotors. Can you take us through how they are performing and some of the challenges you face by increasing your representation with some of these new brands?
Uh, Yeah, from a retail perspective, we've been Omoda Jaecoo Chery now for about 12 months, so that I don't know an Omoda dealer, Jaecoo dealer in the country that's having a bad time at the moment. I think we're all very satisfied. The products are amazing. In particular, the JQ7 that has taken the customer by storm. Not only is it price pointed really, really well, offers a 7-year warranty. The tech on these vehicles is class leading, and also has exceptional curb appeal. So we're seeing great results from a Moda JQ, and that's our most established in Greenhouse from the Chinese entrants. BYD, we've just built a fantastic facility in Telford, a large investment from the group, and we're excited to open that next week. So maybe next year I can come back and tell you how that's performing. But we're excited about that, and the team are incredibly excited about the showroom and the CI there. And then Geely in its infancy, Geely has been open just a matter of months, and it's building momentum nicely. But they're just a few years behind the likes of BYD and Moda Jaecoo at the moment, with how long they've been in the UK and their volume aspirations. But they'll certainly catch them up, and they're doing it in a good manner. And Leapmotor been a great addition to the Stellantis site. We're seeing great volumes come through from a retail perspective. It's actually been quite surprising, but the tech on the vehicles are fantastic, and it's driving conquest customers into our Stellantis showroom, which is needed. And clearly, Stellantis have partnered with a great brand there, and it's working really, really well together. Yes.
Yeah.
And we also have MG as well on the Isle of
Yes.
Wight, and from a Chinese perspective, and that's been performing really, really well for many years, and long may that continue.
Yeah, and you do now represent a number, as I say, of Chinese brands. How much scope is there for you as a business to grow further with some of these brands? And are there any opportunities on the horizon that you can share with us?
Yeah, as we touched on, when we've been to China, we've seen OEMs that we've never heard of, and we go twice a year, every year at the moment. So there's definitely scope for growth. There's ambition from manufacturers that are over there to enter Europe, and in particular UK, because they've seen how receptive the UK market is to new brands, and specifically the Chinese product. Obviously, legislatively, we haven't implemented any tariffs either, so it's quite a welcoming market for them. Um, from our perspective, the Chinese have presented a fantastic opportunity for growth for our business. We have partnered with other established brands as well over the course of the last 2 years in Citroen, Peugeot, in particular. So we're not wholeheartedly going straight towards new entrants, but it's just difficult to grow your business with these established brands because they've already got representation in key market areas that we would find attractive, and a lot of them are right-sizing their network anyway. So the Chinese have just presented the right opportunity for us at the right time. We've also been fortunate that we have some fantastic facilities in Shrewsbury, Telford, and the Isle of Wight, and opposed to having to go out and secure new property, which is a challenge, and which I think many new entrants that aren't in the market as yet will find a challenge. We've been able to divide up, significant showrooms, and we've gone from having, a Solus Vauxhall showroom to having a Vauxhall, Citroen, Peugeot, Leapmotor, and BYD facility on the same site. In addition to that, we've also converted some of our road-facing workshops. We took the decision that we felt that their relevance would diminish over the next couple of years as we transition to EV. So we took the opportunity to repatriate them as a showroom facility, essentially. So that's given us again another foothold in the market and allowed us to grow. As I mentioned, I think the challenge going forward will be all around facilities and property. There isn't a great deal out there. Danny and I were on the road yesterday trying to locate a couple of opportunities so we can continue to expand with a couple of our partners that are already in situ. But as we found out, that everybody's got a similar idea, and it's not going to be simple. And I think if you look at the OEMs that are already here, they are keen to rush their subsidiary brands to market in order to kind of swoop for those rooftops and potentially put a speed bump in the road for some of the newer brands that are coming to market over the course of the next 18 months. So yeah, huge opportunity to grow, but I think it will be more difficult as we progress over the next couple of years.
It is an interesting one, isn't it? I mean, you think not that long ago, we were talking so much about consolidation and the future of the rooftop showroom and things like that. And now, as you say, finding showroom facilities, property, and so to put these new brands in or expand with existing brands is becoming ever more tougher, isn't it? Because all the we talked about 40 manufacturers pre 2019 to 75 to 80 today, and they're all wanting open points and facilities, aren't they? Which is quite a dramatic change in not a very long time.
Yeah, it's amazing how quickly things can change, and it's amazing how quickly the Chinese can represent can see the opportunity that's presented to them. I don't think it's any coincidence that they've attacked the market at a time where some of the established brands were right sizing their networks. I think they saw the opportunity to scale their network quite quickly. And in the case of OJC, as we call them, and BYD, they have done so. I think Omoda Jaecoo are now up to 140 franchises. BYD is something similar. Geely have scaled to 60, I think, as we stand here today. 100 at the end of the year, I think, is the aspiration there, and the likes of Changan are at 50. So, these guys have scaled so quickly, it's almost unfathomable. I think it's probably caught some of the established brands off guard, but ultimately that has been the catalyst to this exponential growth that we've seen from the likes of OJC in particular.
Yeah, exactly. And sticking with established brands, I don't like to call them legacy brands. I think established.
No.
I think they shouldn't underestimate these. But I mean, what trends are you guys seeing in terms of part exchanges from those established brands coming in against the new entrant brands? I mean, there's been research that a lot of it is German, more premium products coming against some of that product. What trends are you guys starting to see on that?
Yeah, I'll take that one. I was doing some data analysis on this just last week. What we're seeing, Phil, is the premium brands coming through the doors. We didn't take long to see sort of Jaguar Land Rover product coming in as part exchange, but it's a mixture. Against the Omoda products, we've had Audi was a big part exchange against the Omoda 9 in particular. So customers coming out of Q5s and taking the 09. And if you've seen that product, you'd understand why. But then we are seeing the volume brands as well, in terms of Kia Hyundai. So it's a mixture of all, but yeah, the premium customers who are coming to the end of their PCPs, who are looking at the new monthly payments, now interest rates have gone up, and sort of pivoting into the Chinese brands instead of renewing their PCP at a higher monthly payment with the volume premiums, BMW, Audi, and alike. So we are seeing it, and it is generating good used car stock for us as well.
I was just going to say that. I mean, you are good volume operators in terms of those used cars. So this must be great to see that kind of product coming in, because it would be feeding you some good quality premium retail product.
It certainly is, and as we all know in the industry, the best car to retail is a part exchange, because you haven't got the auction costs or buyer's fees, you haven't got the logistics fees to get the vehicle from auction or from a motorway or a similar platform. So you do, and you can really see the vehicle at the point of appraisal when they're purchasing the vehicle, and they're usually 1-2 owner cars with full history as a good reliable part exchange. So that has improved our used PPUs by bringing in these cars against the new entrant brands. So it's been all positive.
And Ash, I mean, you and I were chatting pre the job and thinking about the used car park of the future. I mean, we now, all right, BYD, then we've got Jaecoo, Omoda coming up behind them, and others very quickly behind them. Suddenly becoming used car operators, used car volumes, and just in March of this year, the Jaecoo 7, which Danny mentioned before, 10,400, I think, 10,700 registrations in March, with all 78% of the year-to-date volume for Jaecoo. What are you seeing anything now around? Is it still early days? But what's about establishing those used car sales for some of these brands in the future? What's your view of that?
Yeah, I think it is still early days. I think some of the new entrants probably underestimated the importance of the residual value of their new vehicles. I think some of the UK teams that represent the brands have done a really good job of educating their Chinese counterparts around residual values and how they need to protect them, and how it will benefit them long term down the line. And ultimately, big part of my talk when we were out in China a couple of weeks ago with Jaecoo and Auto Trader was around the importance of that residual value and how our market is based around that. And ultimately, a lot of the profitability of the dealer network is built upon the foundation of the used vehicle. We make a lot of our profit from used vehicles, and actually the new vehicle profit tends to be the cream on the coffee, not the actual coffee. So I think there's an understanding there now from the new entrants, and from our perspective, we've had a really buoyant time with used vehicles off the back of, as Danny said, the trade-in, the part exchanges. But I think one thing Danny didn't touch on was there has been a slight cannibalization in our used vehicle volumes. The profits are up exponentially because of that quality stock that's coming in, but the actual volumes have just taken a tiny hit as the new car offering just cannibalizes that used car offering slightly. When you've got a Jaecoo J7, for instance, with 8-year warranty, 349, 0% APR, and you sat in your showroom, and you've got a VW Touareg on the pitch, 3 years old, 30,000 miles, no manufacturer warranty left on that vehicle, 12.9% APR. All of a sudden those worlds are colliding, and the consumer tends to lean towards the newer vehicle rather than the used.
I think if I can jump in there, Ash, you're absolutely right. And other dealer groups that have embraced the new entrant brands like us, Phil and Curtis, are seeing similar patterns. So we're actually down 7% on used car volume year on year, but we're up 90% on new car order take for retail. So the trade-off's excellent for us, but we are losing a little bit of traction on used cars for exactly the reasons Ash has just said. Clearly, you take it to be 90% off on new retail sales. Motability is on parity, so all the growth is in new retail sales, so which is phenomenal. But we are losing those used car customers a little bit to the new car retail sales.
I mean, it is I think they're coming in out, they're coming in strong, either from strong incentives, be it through finance or deposit contributions, etc. And as you say, when it comes to that cost of ownership through, a monthly payment, and putting alongside that, not just EVs, but offering that hybrid capability that gives the consumer that stepping stone towards a more electrified marketplace. It does change that perception, doesn't it, a little bit for weight than that 0 to 12, 0 to 24, and even 0 to 36-month-old used car proposition.
I'd just say a couple more pieces on that, Phil, because it's an important subject, and Ash delivered a presentation on this in China last month. What we are seeing is early days is 80% of new cars roughly are on finance. We know that. So those customers that are a finance customer, there is still cash customers out there, and we're turning our ex demo stock, and there's a few tactical regs from the new entrants. The cash buyers are buying them at what seems to be a bargain, because there is demos that have been written down and a few months old. So right now there's no problem in reselling the used cars, but like Ash said, they're really taking a lot of time to establish their used car programs, and they've been doing this since they arrived in the UK. They're not looking at this now. They looked at this as soon as they landed in the UK. The UK teams and directors of these brands said, look, we need to protect the RVs. We need a good used car program, and BYD in particular. If you buy a vehicle that's in their used car program, it actually comes off your new car target. So they are offering thinking outside the box and offering good incentives for retailers to buy the products to keep the residual value strong.
Yeah, I think you're right, and just to sum that up, I think we shouldn't, and proven already just in the last 2.5 years, you shouldn't underestimate the Chinese manufacturers, should we, in their strategies and entry to market. I think it's very clear that anybody that has underestimated them are being caught out. That they have got a plan, and they do back it up, don't they? So as you say, they very quickly they act very agile to react to market dynamics. Well, we'll be back with more on Greenhouse from Ash and Danny after this short break.
You're listening to all the chatter that matters on the Motor Trade Radio podcast, powered by Cazoo.
Welcome back. Last month, Greenhous released its full year results for 2025 with a 4.2% increase in turnover to £1.87 billion and gross profit up from 130.6 million to 141.2 million. Ash, can you take us through some of the highlights of what powered the group's strong performance over the course of the year?
Yeah, well, I guess we could kind of take it back 3 or 4 years, really, Curtis. So just as we came out the back of COVID, we did a bit of inward reflection into the business and kind of took ourselves on this on the strategy based around diversification, really. So the result has been really underpinned by that. So over the course of the last 2 or 3 years, we've tripled our manufacturer representation, gone from 3 primary OEMs to 12 OEMs. That's that portfolio split 50-50 between established brands and new entrants. And we've really diversified away from the traditional retailer model and looked more towards the affiliated services that we believe add a bit more value to both our OEM partners and our fleet partners. So I guess anybody who knows our business knows that we're primarily focused around the fleet market. I think we're 97% fleet from a volume perspective and 3% retail. Sorry to say that, Danny. So over the course of the last 3 years, we've expanded our fleet footprint. We're now about 220 acres across the country. So that gives us capacity to hold somewhere in the region of about 24,000 vehicles on the ground at any one point in time. And last year we facilitated 90,000 fleet units across multiple segments within that channel, and 3,000 new retail units. So kind of those affiliated services that I touched on. So we do a lot in respect to logistics. We call it the unglamorous stuff. So we'll do a lot of logistics on behalf of our OEM partners. So port movements into dealer groups, facilitate our own fleet movements. We've also expanded into refurbishment and remarketing, so adding value services to our funder partners, our broker partners, our rental partners, our OEM partners. So we've got agreements in place with a couple of new entrants in regards to managing their approved used programs as they come to fruition over the course of the next 6 to 12 months. And in addition to that, we also do things like software development. So we develop all our own software as well, and we actually license that out to a number of people as well. So multiple revenue streams really. So we are primarily a retailer, but we back it up with a lot of ancillary services, which do complement the bottom line.
I mean, it's all found extremely busy. I mean, Danny, I know I think Ash said that you're only 3%, but I think you're busy enough on that 3% and everything else that you're involved with, aren't you? So, I mean, focusing on new car vehicle sales, I mean, including cars and LCV, I mean, just correct me if I'm wrong with this, but you sold over 93,000 units, giving you a total market share of 4%. I mean, how did this compare year on year? And talk us through what drove these sales. I mean, you've touched on it before with some of those that growth of 90% from the new entrants, a slight erosion from used, but on balance between that retail and fleet side of things.
Yeah, so year on year, really, performances was quite similar. So last year primarily was based around the integration of those new entrants. The likes of BYD, OJC have only really been in our portfolio for 18 months, and they've only really been establishing themselves over the course of the last 18 months. So comparatively, the volume growth was fairly nominal, and that's reflective on the year-on-year profit before tax. So we're actually expecting a fairly significant period of growth over the course of this year in particular. So modest growth in respect to volume is about 4,000 units in total. Profit up about £1 million. We suffered some really exceptional costs in throughout last year as we kind of transitioned our business away from some subsidiaries that weren't really contributing in the way that we wanted to. Performance was primarily driven by fleet, as I've mentioned, so we're roughly 97% fleet. But our retail operations have been growing exponentially over the course of this year, as Danny's touched on. So I think we saw 136% new retail growth overall. Primarily a lot of that coming from the new entrant partners that we've selected. So yeah, no, it's been a really positive time, and we expect a lot of investments that we've made over the course of the last 12 months to really start to bear fruit throughout the course of this year. And as we sit here today, it looks like that's where we are.
And just to bring us up to date, how has trading been in the year to date? And also, how do you see the group's performance and the market panning out as we enter the second half of the year?
So I'll take this one. So yeah, as Ash has just touched on, we are expecting this year to be better than last, because the new brands are coming to fruition, but the established brands are still key components in our operation, and our relationships with those are very strong. Year to date, we've seen an increase, as I've said. We have seen it in retail, a 90% increase in performance. Which is fantastic. Slight erosion, as Phil put it then, on used, with profit per units being up. We see this year continuing in that acceleration, where we don't see it slowing down at all. And we believe in fleet and retail that this year will dominate last. And we do believe the new car market is going to grow this year. Just hit just over 2 million last year. Not going to give you a number, Phil, because you'll hold me to it, but we do believe that used car market is under a little bit of pressure, and the new car market will prevail.
I think to add to Danny's point, I think it's kind of well documented that the that the market is heavily weighted towards fleet, which kind of aligns with our strategy. So we budgeted for 20% year-on-year growth based off of that. I think as we sit here today, we've delivered 60,000 vehicles year to date, so which is in line with our budget. And as Danny mentioned, that a lot of that growth is coming from our new OEM partners, but those new OEM partners also include Citroën and Peugeot. And I think you can see from the SMMT figures, particularly with respect to Citroën, now that they've got some product on the ground, they've really come out swinging and fighting for their market share. And we're seeing that across the board with all our established OEM partners. Danny and I sit at those investors meetings fairly regularly. We were at the Nissan one in May in particular. Every one of our brands has a plan of how they're going to defend their market share, and in many respects grow their market share. And when you listen to it, and you see it in black and white, you can't disagree with it. It looks like that their strategy will stand up. A lot of it will come down to the new product that is coming to market, but that looks exceptionally competitive. And they understand the market a lot better than most. So we expect to see growth from all of our OEM partners over the course of the remainder of this year and into the next year. So exciting times.
I think just touching on both your points there, that I think you've got that growth, you've got the aspiration, you've got that fight for market share coming from the new entrants. But as you say there, Ash, that we don't underestimate the established brands in their defensive market share, new products coming into market, which when you've got a business such as yourself, that you've got a diverse partnership of OEMs, both established and new entrants, that you sit in a very good position there, don't you? Because you kind of win-win from both. And it's just like you say, it's just managing that erosion of used correctly enough. But again, is that potentially offset by some of that product that you're getting in as parts exchanges, as Danny mentioned before, from some of that premium stock that you may not naturally represent that brand, but you start to benefit those as used vehicles with some good profitable margins on.
And we are making the most of those opportunities. We don't mind selling a few less used cars if they're more profitable. Just going back to the point on the traditional brands, just there, yesterday we saw Peugeot realign their pricing to become more competitive. They have lost a little bit of market share this year, but I think some of that was on purpose. They had a really great year last year. And in terms of the European brands, these are global brands that have been established a long, long, long time. They're certainly not going to go down without a fight, and they've certainly, got a plan. And like I said, we have seen that firsthand, and we're really excited about what they can bring, particularly with Stellantis. We know that they've got plans. We know that they're talking about joint ventures, and they've already started one that's proven a success with Leapmotor. So yeah, it's great to be in bed with the Chinese and the new entrants. It's exciting, and they're scaling rapidly. But we're the core of our business still remains around the established brands too. So long may it continue on both flips of the coin, really.
Yeah, no, I couldn't agree more. And we shouldn't forget that after sales revenue as a business, should we? That the importance of that aftermarket, that use part that does deliver significant commercial benefit to the business, doesn't it? And that at the minute is mainly coming from the established manufacturers as a brand.
Absolutely. Yep. Very important. We've all got to try and absorb our costs as much as possible. And one thing I don't think we did touch on was we had a great year last year, and we increased on the year before overall. And we're not seeing that from a lot of dealer groups at the moment, because dealer groups like ourselves have had to take, NI increases, minimum wage increases, which has a knock-on effect to the skilled level workers in your business. So to focus on after sales and really drive that absorption up as much as possible, it is a huge focus of ours on service plan sales and replacing oil sales in the future. And as EVs, cost per invoice will be lower. It's how do we become more efficient, or how do we get more throughput through the workshop. So after sales is very high on our agenda right now.
No, and I think, for your organisation, your business to put out those numbers for last year and what you've got planned for this year and taking some of those costs in last year, I think is exciting times for you, for, as you say, a great opportunity in 2026 for even a better year in terms of that volume. I suppose the last question is, do you both agree that the UK could be a 3 million new car market that's been muted around the sector for one of the new entrants, or not?
No. As Danny said, I think there'll be.
Yes.
I think there'll be a significant increase on last year. Where that ends up landing, I'm not sure. I mean, I will put a number on it. Danny's probably too scared to be held to it, but I think we'll be around 2.2, 2.25.
Yeah.
But that is a push market, and whilst we're all keen to get back to a high performance market, I don't know if that's a good market for everyone.
Yeah, we've got to get very careful, aren't we? I mean, we don't want to go back to the pandemic days of short supply and healthy margins and very much a pull market, but we just don't want to enter too much back into the heavy push market that is not healthy financially, is it, for margins in the used car market? But I think you're right. Danny knows me well enough. I think that 2.2, 2.25 feels about right. I think the 3 million could happen in terms of supply, but it won't be healthy. Forgetting, notwithstanding storage and logistics, which you guys operate within, and the pressures we're all feeling in that sector at the minute. We're at 42.5 million vehicle park now in the UK, which is a record vehicle park. We don't want, it's getting hard enough as it is, isn't it?
I think what we did see, Phil, obviously we saw the market get off to a ferocious start at the start of this year. But the end of May, I think we saw our manufacturers just take a little breather. I think they saw the opportunity, and it'll be interesting to see what the SMMT figures show us in the coming days. But yeah, it just felt like they had the opportunity to take their foot off the gas, and they did so.
Yeah.
Let's see what the data tells us, though.
For Q1 under the belt, get that position for the year, and then just ease off a little bit for the rest of the year. I've been trying to get you guys on for a while, and you haven't disappointed. And I think, Danny, should we start planning next year's podcast now, and then we'll make sure we get a date in the diary.
I've written 2.25 down, so I'll save that in my diary.
Just play that.
We'll revisit that next year.
You'll have a copy of the recording just for evidence anyway, Danny, if you do.
Fantastic.
You have reviewed. For me, it's fascinating. I think you guys have sat, the times that you've been spending in China and looking what's on the horizon and like gives you that future lens for what's to come in the next 5 years, really. To, where you operate within the sector in terms of that diversity of a business and the lens that you have from both the established brands through to the new entrants. And I know you are embracing the new entrants, but you're embracing it strategically with the right partners, the right relationships, etc. So it's fantastic to have you both on, and great congratulations on a performance for your financials as well. I mean, great result with that one. And as I say, we'll hopefully get you back on the future, and you can talk about how 2026 panned out and whether Ash's forecast was right at 2.25. So we'll talk about that one in the future.
Excellent.
Brilliant. Thank you, guys.
Thank you for having us.
It's been an absolute pleasure having you both on. Unfortunately, that's all for now. So many thanks for listening to this special weekday episode. Thanks once again to Ash and Danny for joining us. We're back with the news headlines this weekend. Until then, it's goodbye from me.
And it's goodbye from him.
Thank you for listening to the Motor Trade Radio podcast, powered by Cazoo.